Welcome to our podcast channel. I am your host. Today, we are diving deep into the world of investments, specifically focusing on real estate investment strategies and how they tie into your life stage and financial goals. We are also going to touch upon the subject of dividends and options for effective loans when considering real estate investments. Seasoned investor or new in the game, there is something here for everyone. Let's get started. Investing in real estate can be rewarding to grow your money over time, but it also involves some risks. How much risk are you willing to take with your money? And how does that affect your investment strategy? These are important questions to ask yourself before investing, as they can help you choose the right investments for your goals and preferences. Here, we will explain investment risk tolerance, how to determine yours, and why it matters for your investment strategy. First, let's unpack the concept of investment risk tolerance. What is it? Simply put, investment risk tolerance is a measure of how comfortable you are with the possibility of losing money on your investments. It reflects your attitude towards the uncertainties that come with investing. There are generally two types of investors. One is risk-averse investors. These individuals prefer safety and stability in their portfolios. They might choose investments like bonds or cash equivalents that may have lower returns but provide more security. Another one is risk-tolerant investors. These investors are willing to accept fluctuations and volatility in hopes of achieving higher returns. They often invest in stocks, real estate, or other assets that can yield significant profits, albeit with increased risk. Importantly, risk tolerance is not static. It can change over time based on personal circumstances, financial goals, and investment experiences. For example, an investor nearing retirement may become more risk-averse, while a younger investor who has had success with a high-risk investment may feel emboldened to take on more risk. As you consider your investment strategy, it's crucial to assess your own risk tolerance. Reflect on how much risk you're comfortable with and how various life events, like a new job, marriage, or children, might change this tolerance over time. Now let's talk about financing your real estate investments. Understanding the landscape of real estate investment loans is crucial before diving into property ownership. Now let's understand what are real estate investment loans. Real estate investment loans are distinct from traditional mortgages, intended for purchasing properties meant to generate income or appreciation rather than being lived in. There are several types of loans, each catering to different investor needs. Let's understand each one of them one by one. First one is hard money loans. These are short-term, asset-based loans primarily used by investors who need quick cash. The primary determinant for approval is the value of the property, making them accessible even for those with less than stellar credit scores. While they can be secured quickly, they often come with higher interest rates. This makes them ideal for short-term projects such as flipping houses. The second one is private money loans. This type of financing comes from private individuals or investors rather than institutional lenders. Terms and rates vary significantly, often negotiated between the involved parties. Private loans can be more flexible but do carry risks depending on the lender's requirements. The third one is fix and flip loans. Designed specifically for investors who purchase properties to renovate and sell quickly, these loans often come with short repayment periods and higher interest rates due to the quick turnaround expectation. This strategy can be profitable for experienced investors who know how to manage renovations efficiently. And last one is home equity loans. For homeowners looking to invest in additional properties, leveraging the equity built in their current home can be a smart move. These loans allow homeowners to borrow against the value of their home, providing capital for a new investment property, often at lower interest rates than traditional investment loans. When pursuing real estate investment loans, it's vital to conduct thorough market research. Understand current real estate trends and calculate your investment's potential profitability. Looking at previous ROI or return on investment will help set realistic expectations. Next, let's explore the concept of dividends, which can significantly enhance your investment portfolio. Dividends are payments made by companies to their shareholders, usually derived from profits. They are essentially a way companies share their successes with investors. But you need to know about dividends. Let's understand each one of them. Dividend yield. This is the annual dividend payment divided by the stock price. A higher yield can indicate a more lucrative investment, but it's essential to assess whether the company can sustain its dividend payments, especially during economic downturns. Types of dividends. There are cash dividends, where you receive cash payments directly, and stock dividends, where additional shares are issued. Understanding these options helps in tailoring your investment income strategy. Tax implications. In the UK, as of the 2023-24 tax year, investors have a $2,000 tax-free dividend allowance. Beyond this, dividends are taxed based on your income tax bracket. Basic rate taxpayers are charged 8.75% on dividends exceeding the allowance. Higher rate taxpayers pay 33.75%. Additional rate taxpayers pay 39.35%. Being aware of these tax implications allows you to maximize the efficiency of your investments. Furthermore, using tax-efficient accounts such as ICAs can keep your dividend earnings tax-free, enhancing your overall returns. Now, let's look at how your investment approach should change based on your age and life stages. This concept is often referred to as life stage investing. Early career, 20s to early 30s. In this stage, many face student loans and other debts. However, this is also the optimal time to start investing. Younger investors can afford to take more risks since they have more time to recover from market fluctuations. Consider focusing on growth investments like stocks or ETFs that can provide long-term returns. Next one is career development, mid-30s to 50s. This period often signifies peak earnings, making it an ideal time to significantly ramp up savings and investments. Balancing your spending with aggressive saving for retirement is vital. Many in this phase also face additional responsibilities such as children's education or mortgages, which can impact financial decision-making. Now, next stage is pre-retirement, late 50s to 60s. As you approach retirement, your investment strategy should shift from growth to income generation and capital preservation. Diversifying your investments to include safer assets like bonds or dividend-paying stocks can help protect your capital while ensuring a steady income stream. Next one is retirement, 65 and beyond. At this stage, your focus should be on ensuring your savings last throughout your retirement. You may want to engage in systematic withdrawals or consider annuities for guaranteed income. It's crucial to adapt your portfolio to manage potential healthcare costs and adjust for inflation. No matter your stage, regularly revisiting and adjusting your investment strategy is essential for long-term financial health. In conclusion, understanding real estate investment loans, optimizing your dividend strategy while considering tax implications, and tailoring your investments based on your life stage are all key factors for financial success. By being informed and proactive about your investment choices, you set yourself up for a robust financial future. Thank you for tuning into our podcast. I hope you found this discussion helpful. Be sure to share your thoughts or questions and join us next time as we continue to explore investment strategies that align with your financial goals. Don't forget to subscribe and spread the word.